Refund mechanics are where the gap between processor records and bookkeeping records gets created, usually quietly, almost always at year end. A coach issues a refund in Stripe, the cash moves, the client is satisfied, the matter feels closed. 3 months later, the 1099-K arrives showing gross revenue that does not match the bookkeeping revenue figure, and the search for the discrepancy begins. The procedure in this unit is the discipline that prevents that search from ever starting. Processor side, book side, and the bank statement. 3 records, 1 number every time. Pressing the refund button in Stripe feels like the whole job, and that is the assumption the rest of this unit dismantles. The processor side moves cash and absorbs fees. The book side records the revenue reversal that keeps your financial picture honest. Skip the book's entry, and the bank statement no longer matches your bookkeeping software. The mismatch is invisible until reconciliation surfaces it, which usually happens in January when the 1099-K arrives, and you have lost the context to fix it cleanly. Treat it as a two-sided procedure from the start. The processor side is a procedure with 4 moves, and the one most coaches skip is the explicit client notification. Find the original charge by client and date, not the dashboard summary. Choose full or partial. Confirm the dollar amount against the clause in your refund policy that authorizes it. Click Refund. Then send a short email to the client confirming the amount and the 5 to 10 business day return window. Stripe does not always send that notification cleanly, and the client's bank will not show the credit for several business days. The email closes the loop and prevents the "where is my money" follow-up that arrives on day 7. The fee absorption is the surprise that catches every coach exactly once, and it changes the economics of every satisfaction guarantee offer. Stripe charged you 2.9% plus 30 cents on the original transaction. When you refund the customer the full amount, Stripe keeps that original fee. The customer gets $1,000 back. Your bank account is out $1,000 plus the $30 fee you already paid and will not see again. The economics at 1 or 2 refunds a year are absorbable. The economics at a scaled satisfaction guarantee program with 5% refund rates are not. Run the multiplication before you advertise the offer. On the book side, the single most important reframe is that a refund is not an expense. It is a revenue reversal. If you book it as an expense, your gross revenue for the period stays inflated, and your expense line carries a category that does not exist on any real chart of accounts. The correct mechanics are different. The refund goes back against the same revenue account where the original payment landed. In QuickBooks and Xero, this means a credit memo applied against the original invoice. Net effect on the period. Recognized revenue reduced by the refund amount, and the books match the processor. Partial refunds are where most reconciliation gaps start, because the math has to be proportional, and the credit memo has to mirror the proportion. A $500 refund on a $1,500 engagement is a credit memo for $500 against the original invoice, applied to the original payment, not a $500 adjustment to a new account, not an expense entry, not a journal entry against retained earnings. A proportional credit memo against the original invoice. Get this wrong, and the 1099-K reconciliation in Module 10.2 surfaces a variance you will spend hours hunting in January. Timing windows matter because the calendar month the refund posts to is the month the books recognize the reversal, regardless of when the original charge landed. Standard processor refund windows run 30 to 90 days from the original charge. Past that window, the processor may require a different mechanism, direct bank transfer instead of card credit, and the book's treatment changes to match. The other timing trap is the month boundary. A January charge refunded in March reduces March revenue, not January. On cash basis, this is the correct treatment, but tell your bookkeeper if it distorts a monthly P&L you report on. The worked example walks the full procedure end to end, so you can see the three records line up. $500 partial refund on a $1,500 engagement, original payment via Stripe. Stripe absorbs the fee on the original transaction and posts a negative $500 to your payout statement. QuickBooks gets a credit memo for $500 against the client invoice, applied to the original payment. Bank statement shows a $500 debit on the date the payout cleared. 3 records, 3 matches, period revenue reduced by exactly $500. That is the discipline. Before you close the unit, run the verification on any historical refund you have processed, because the gap is easier to find now than at year end. Pull every refund issued in the last 6 months from your processor. For each one, find the matching credit memo in QuickBooks or Xero and the matching debit on the bank statement. Same client, same amount, same period, or an adjacent period with a documented note. Any refund where the 3 records do not line up is a reconciliation problem that will surface when the 1099-K arrives. Fix them now while you can still remember which client and which engagement.